Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 24th of November. Let's dive into the week's top market news. Tech jitters and rate uncertainties weigh on European markets despite economic resilience. European equity markets faced a challenging week, closing significantly lower as investors grappled with renewed skepticism regarding artificial intelligence valuations and receding expectations for an immediate interest rate cut in the United States. The Pan-European Stocks Europe 600 index ended the session 2.21% lower, reflecting a broader trend of risk aversion across the continent. Major national indexes were not immune to the sell-off, with Germany's DAX losing 3.29% and Italy's FTSE MIB declining by 3.03%. Similarly, France's CAC 40 index dropped 2.29%, while the UK's FTSE 100 index showed slightly more resilience, but still weakened by 1.64%. Despite the turbulence in equity markets, the underlying economic engine of the Eurozone showed signs of stability. Early readings from S&P Global regarding the Purchasing Managers' Index's PMIs indicated solid growth in November. The HCOB Eurozone Composite PMI, a key gauge of overall economic health, slipped marginally to 52.4 from October's 52.5, but managed to beat the consensus estimate of 52.1. This expansion was primarily driven by the services sector, which climbed to an 18-month high of 53.1, effectively offsetting a contraction in manufacturing, where the gauge fell to 49.7. Regional data painted a mixed but improving picture. German output continued to expand at a slower pace, while France's private sector activity improved, bolstered by a strong services sector that pushed its overall PMI to the brink of expansion at 49.9. Meanwhile, consumer confidence in the Eurozone held steady at -14.2, an 8-month high, though it slightly missed market expectations. Across the channel, the economic narrative in the United Kingdom focused on the delicate balance between inflation and wage growth. Annual consumer price inflation slowed to 3.6% in October, down from 3.8% the previous month, driven by falling prices in airfare, gas, and utilities. This cooling inflation has boosted market hopes for a potential interest rate cut in December. However, caution remains the watchword at the Bank of England. Chief economist Hugh Pill recently noted that wage growth remains significantly above the central bank's 2% target, suggesting that his views on policy are unlikely to shift drastically in the short term. Nevertheless, Governor Andrew Bailey has indicated that further policy easing could be on the horizon if disinflationary trends become more clearly established. Now our insight into alternative markets. The Alchemy of George Soros. The theory of reflexivity and market bubbles. George Soros's theory of reflexivity is one of the fundamental concepts for understanding financial market movements and their dynamics, especially in the formation and bursting of speculative bubbles. Soros, whose success as an investor is largely based on the application of this theory, argues that markets are not governed by immutable physical laws. On the contrary, they are social phenomena involving the interaction between objective reality and the expectations of the participants. The reflexivity cycle, the interaction between expectations and reality. The theory of reflexivity describes a two-way relationship or feedback loop between the participants' bias examples, their expectations, beliefs, or narratives, and the objective or fundamental situation they are trying to comprehend. Reflexivity is thus the idea that participants' expectations can influence, and in turn be influenced by the market's fundamental reality in a continuous cycle of self-reinforcement. This process unfolds in two distinct functions. The first is the cognitive function or expectation, where participants attempt to understand the world. However, their comprehension, which is translated into a narrative, is always imperfect and inevitably contains a prejudice bias. The second is the manipulative function or causality, where this prejudice, when acted upon by a significant number of participants, transforms into a causal force that influences objective reality. For instance, buying and selling decisions based on bias modify prices and financial conditions. The final result is a circular process in which expectations, by being acted upon, change reality, and the modified reality in turn reinforces the initial expectations, thereby fueling a positive feedback cycle. Application of the law, the ignition of trends and the speculative cycle. It is precisely reflexivity that explains why some market trends not only persist, but also escalate into exaggerated phenomena, such as speculative bubbles. The cycle begins with the ignition bias and new narratives, where a dominant prejudice or a new narrative emerges that deviates from reality, which could be the rise of a new technology, like the internet in the 90s, or a dramatic shift in monetary policy, such as ultra-low interest rates. The new narrative, with its promises, for example, technology X will change the world forever, pushes investors to believe that the value of certain assets is underestimated or that future growth is guaranteed. This is followed by the autopoiesis phase positive feedback, where the trend is reinforced by reflexivity, often in a prolonged and sometimes excessive manner. The mechanism is simple. Purchases based on the narrative push prices upward, and the rise in prices, which is objective data, validates the initial narrative, we were right. The trend is strong. This price increase improves financial collateral and system liquidity. Companies can issue new shares at high prices, and loans become easier. Consider a home whose rising price secures a larger mortgage. This vicious circle creates the financial conditions for a further detachment of prices from fundamentals. The trend thus feeds on itself, transforming an initially rational movement into unsustainable speculation. Previously skeptical investors capitulate the fear of missing out, FOMO, and join the trend, pushing prices even higher. This is the moment when the bubble is created, when the bias is so deeply rooted that it becomes the dominant market reality for an extended period. However, the cycle cannot continue indefinitely, leading to the testing phase point of inflection, where participants' expectations are put to the test. The error becomes evident when prices have reached such a high level that, even with positive expectations, objective fundamentals can no longer justify the valuation, and doubt begins to creep in. The first signal is given by a minor event, the negative trigger that breaks the inertia of the positive feedback. This could be the failure of a key company, an unexpected rate hike, or a downward revision of earnings. This trigger reverses the direction of the feedback loop, leading to the reversal phase, negative feedback and collapse, which is the negative cycle or speculative panic. The mechanism is the opposite. A drop in prices, objective reality disconfirms the initial narrative, maybe we weren't right after all. The prejudice reverses drastically, shifting from euphoric optimism to panic and pessimism. This leads to the withdrawal of liquidity. The price drop reduces the value of collateral and liquidity. Margin calls and the need to liquidate positions to honor debts force further selling, causing a downward domino effect that is the mirror image of the bubble. The vertical decline is often faster and more violent than the ascent, as sales are dictated by the need to exit the market and panic, amplifying the fall well beyond the restoration of fundamentals. The role of narratives and the real mess. Soros emphasizes that the real challenge for investors is not simply to understand reality, but to understand the expectations that are guiding others. His success comes from the ability to identify the biases driving the markets and to bet on their exhaustion or reversal. Reflexivity implies that markets are a real mess, where uncertainty is the norm and cause and effect laws are non-linear. The successful investor acts counter-trend, not by following the trend until it is fully validated, but by playing against the trend's extreme extension as soon as the reflexive cycle becomes patently unsustainable or the participant's bias is too strong. In summary, the theory of reflexivity explains why financial markets are inherently unstable and prone to excesses. They are not equilibrium mechanisms that converge toward fundamentals, but dynamic systems that continually oscillate between extremes of optimism and pessimism due to the imperfect and self-referential nature of human beliefs. Would you like to analyze a historical case, such as the dot-com bubble or the 2008 housing crisis, by applying the reflexivity cycle?
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.